All right, welcome to Talk Tickers. Today we're going to dig into a really interesting one, Life360's Q3 2025 earnings. And let me tell you, this report is a real head-scratcher. On one hand, you have what looks like a spectacular success story. But on the other, well, the market's reaction was something else entirely.
So get this. This is the disconnect in a nutshell. The company comes out, reports a record quarter, and even raises its guidance for the full year. You'd think that's champagne popping time, right? Well, nope. In response, the stock just gets hammered, plummeting 22%. A total, complete disconnect.
And that's the big question we need to answer today. It's pretty simple, but it's critical. How does a company deliver a massive beat and raise, and then the very next day, the stock falls off a cliff? What on earth happened here?
Okay, let's dive right in, and we'll start with the numbers, because honestly, on paper, this quarter was an absolute blowout. If this was the only information you saw, you'd have bet the stock was going to soar.
First up, let's talk profits. GAAP earnings per share came in at 11 cents. Now the analysts, they were expecting way less. This was an 8-cent beat, which is a staggering 267% above what was expected. So the key takeaway, this company is solidly profitable. And what about the top line? Revenue. A record quarter there too. We're talking $124.5 million. That's a 34% jump from this time last year. And it also nicely beat what Wall Street was predicting. So far so good. Everything's looking pretty great, right?
Now this is where things get really interesting. I mean, look, 34% revenue growth is fantastic, don't get me wrong. But check out the adjusted EBITDA growth. It absolutely exploded, surging 174% year over year to $24.5 million. What that tells you is that as their revenue goes up, their profits are going up way faster. That is some incredible operating leverage at work.
In the core of the business, that subscription engine, it is firing on all cylinders. Paying circles, that's the family groups who subscribed, grew by 23%. They added a record 170,000 new subscribers in just 3 months. But the real standout metric here, operating cash flow. It exploded by 319%. This business is just a cash machine.
And you heard it right from the top. The CEO, Lauren Antonoff, was on the earnings call basically saying, hey, we knocked it out of the park. She's talking another record quarter, all-time highs. From management's perspective, the execution was just flawless. And yet, that's not the part of the story that moved the stock. Because buried in that same glowing earnings report was something else, a major strategic announcement. And this, right here, is the pivot point. This is where the market's interpretation of the story completely diverged from the company's.
So what was it? Life360 announced that it's acquiring a company called Nativo, which is a native advertising technology platform. Now listen, this was not some small, easy tuck-in deal. This was a fundamental shift in their entire strategy.
And it's a significant bet. The deal is valued at roughly $120 million in cash and stock. For a company of Life360's size, that is a major capital allocation decision.
So why do it? Well, management justified the move as part of their long-term vision. They want to become a broader platform for family life, moving way beyond just being a subscription service. The goal, really, is to find new ways to monetize their massive user base.
So that's the what. Now for the why. Why did the market hate this move so much? Let's decode that 22% plunge and break down exactly what spooked investors.
The market's fears really boil down to 4 key concerns. First, a pivot away from that clean, high-margin subscription money toward the much messier, lower-margin world of advertising. Second, this just dilutes the core story that investors bought into in the first place. Third, there's a huge amount of execution risk. I mean, trying to integrate a completely different kind of business is really hard. And fourth, this all happened while a key growth metric was already showing signs of weakness.
And on that last point about slowing growth, let's look at the one key metric they actually missed: global monthly active users. The street was looking for around 94 million, but Life360 delivered 91.6 million. Now that miss, even though it seems small, it just fueled this whole narrative that their top-of-funnel growth is slowing down, which makes a risky acquisition seem even more ill-timed. And as you can see, the result of all these fears is a dramatic divergence in performance. Over the past month, while the broader software sector was actually up over 6%, Life360 plummeted more than 23%. The market is aggressively pricing in this new company-specific risk.
So, putting it all together, what's our take? How should investors be thinking about the stock as we head into the next quarter?
We're assigning a rating of market perform. Here's why. The underlying business is executing exceptionally well, but this Nativo acquisition introduces a significant unproven risk to the story. We think the stock will probably trade sideways for a while, until management can actually prove they can integrate this new business without distracting from their core subscription engine.
And that brings us to our outrageous but plausible trade idea. The theme here is to play this clear divergence we're seeing. The trade itself is a pair trade. You go long the software sector through an ETF like IGV to capture that broader industry strength, while at the same time you short Life360. This basically isolates your bet against Life360's specific execution risk with this Nativo deal. The catalyst to get out of the trade? Clear evidence that the integration is succeeding and that their monthly active user growth is back on track.
All right, and just to wrap up, we have our standard but very important disclaimer.
This is not financial advice.